And it's been a lot about the global mood and the global rally. Jim O'Neill of Goldman Sachs joins in as promised. Jim, good to have you on the show. First, your reaction to this much talked about Geithner plan.
I think it's quite encouraging. There's a number of important issues which I think make the environment a bit better for this plan to be successful than previous ones. First of all, in the background there is some evidence that house prices might be close to the end of their downturn in the US, which means that people can now see into the future without worrying about an unknown degree of future fresh debt problems out there, which is highly important, arguably the most important thing. Secondly, linked with that, valuations are now so compelling. And then thirdly, with the style in which they're coming up with this idea, effectively the US Treasury is almost creating another carry trade for many investors, which, as has been the case in the past, is often very attractive. So I think you put the three of those things together, it is reasonably encouraging, as witnessed by the very positive reaction by the markets on Monday.
Morning, Jim. Can you say with confidence, though, that the worst is over for housing?
Well, of course, unfortunately, we will never know until after the events, but it is certainly the case that in the past fortnight, for the first time in many months, a number of important US indicators, particularly those relating to the housing market, have surprised on the upside. And given how weak everything has been and for so persistent length of time, it is definitely an encouraging development. And let's hope it's for real. Because if it is, then it's going to herald a much better second half of 2009 than many people seem to be thinking about until very recently.
There have been, though, various reasons put forth for this rally we've seen in equity markets. Jim, what would you put it down to?
I think the two things that we've already discussed, I think the Geithner plan coming at the same time as some evidence of stabilisation of the US economy are both highly important factors. I think there are probably two other ones that are just as important. The market had been so weak before that many people were starting to talk and increasingly believe the idea that the whole equity culture that's dominated the past 30 years or so around the Western world has come to an end. And so that's a sign of how much people have given up on investing in equities. So that's important as well. And then more fundamentally, as I've believed for some time, I think China is showing signs of doing better than many people thought. And people are starting to agree more with my view that China is going to cope with this crisis pretty well. And by the second half of this year be growing back above 8%.
Does all that mean, Jim, that people are getting slightly edgy, or the money managers are getting slightly more edgy about sitting on the large piles of cash that they have been holding for the last 3-4 months?
I mean, clearly that is true. I was asked by a very big client in a meeting yesterday, what did I think the most overcrowded position was, and I said cash. All over the world, people have been so worried about preserving what wealth they have left, whether it be hedge funds, long-only money, private investors, family offices, and even sovereign wealth funds. There is a large amount of cash around that is sitting nervously waiting for signs of things to be better, and of course as soon as markets start to go up, the temptation to invest is there. So I think that is a highly important background factor to all of this.
What's also helped Asian markets, though, Jim, is the way the dollar has depreciated. I mean, how do you read that? Temporary phenomenon, medium term? What kind of targets would you work with for the rupee, for instance?
I think the dollar's a bit of a trickier call. I can see some very positive things for the dollar, which, amongst other things, is appealing because the consensus remains so bearish. But the rise in the US savings rate and the decline in the US deficit are both very important new positives for the dollar. Against that, you've got a really aggressive Federal Reserve Board and the US authorities doing whatever they can to revive the economy, which are basically negative. And the two forces are kind of competing with each other. And it's not clear to me that we're going to see a massive move in the dollar against major currencies for some time. I think there is one other important factor which is starting to get some attention the past couple of days. Ahead of this G20 meeting, Chinese policymakers have made some very interesting comments in an article on their own on the website of the PBOC, in which they appear to be suggesting that they think we need to have a greater role of the SDR and less importance of the dollar globally, which it's quite a surprise to read that piece, but if they really believe it, this opens the door to two things. One, that people will be thinking again about reserve diversification out of the dollar, and two, that maybe the Chinese are going to be open to letting the renminbi strengthen again. And if that happened, that would be very bullish for a number of Asian currencies, possibly including the Indian rupee.
We've taken your point, Jim, on the improvement in the US economy, but what's your sense of what's going on in the BRICS universe, not even emerging markets? Would it be fair to say that the BRICS countries or the economies are still can make a case of being much better placed than the US?
No, I think that's right. I think if you look carefully at the performance of equity markets since last November, China has outperformed the US by close to 50%. And the China rally started on November the 10th, which is the day of the big Chinese fiscal stimulus. What is also interesting, that two of the other three BRIC markets, Russia and Brazil, have both been in positive territory for the year so far and have also, therefore, strongly outperformed the US. India has lagged the four, and I think that's because there's not really an Indian story, and it's definitely related to the election. I often joke with some Indian policymakers that it feels as though we've been waiting for this Indian election forever. And more specifically, many people have been, including Indian policymakers, have been thinking about it since last spring, almost a full year, in which time China's probably created something like close to the equivalent of half of India's GDP. So it's important that this election is put behind us. Hopefully we can see a workable balance of a coalition, and that India gets on with some policy changes and reform. And if that were the case, then India could join the party of the rest of the BRIC countries and in fact possibly be another surprise positive story for the world. But I think it's very important that we get a workable majority or consensus coming out of the election.
How high then would you rate the chances of both these events, Jim? A, that the current equity market rally surprises most with the quantum that it can gain, and B, that equity markets may have put the worst behind them for the rest of this year?
You know, I think the thing is that the volatility of the equity market, on top of the fact it's primarily been downwards, it just makes many people really lacking a lot of self-belief and a lot of confidence that any move that happens will last. So the mood is very fragile still, and I think despite the impressive degree of the rally we've seen the past 10, 11 days, many investors I speak to are still really cautious. I see that as a good sign, because that means if we continue to get better economic data and evidence of more aggressive policies, that means there's plenty of scope for the equity markets to rally further. And I think it's not inconceivable that we could have seen some kind of significant bottom here. There's an interesting picture going around that some people have sent to me showing how equities have performed in the past 11 days, compared to the few similar periods in history. I think past 100 years there has only been 4 occasions where the US market has rallied this much in 4 days. On 3 of those 4 occasions, it has been the start of a major equity market rally. And so it is possible that could be the case now, but we need to see, obviously, a lot of evidence that the worst of the world recession is behind us, and we'll keep our fingers crossed on that.
Jim O'Neill, always a pleasure. Thanks very much for stopping by today. That's the voice from Goldman Sachs with